Hey everyone, in this video we're going over Netflix stock, how it crashed recently, and why I'm buying the stock at these prices. Now before we get into it, if you could smash the like button, it really helps the YouTube algorithm, and if you're not subscribed yet, definitely subscribe to the channel. Now let's get into it. So Netflix stock ended the day yesterday at $387.15. That was down 30% in the past two trading days, being Monday and last Friday. Its 52-week high is $700 a share, and its 52-week low is $351 a share, which it hit yesterday on Monday, being down 50% from its all-time high. So let's go over why the stock dipped so much so quick. Well, one, the stock was down 30% in the past two trading days because they had their earnings report. And in their earnings report, they had a low guidance for Q1 2022, the next quarter. Netflix gave an estimate of 2.5 million new subs in the next quarter. Now, that's lower than the Q1 of 2021, 2020, 2019, and 2018. So, because of that, the market is basically believing that maybe the entire year is going to be much lower than the past years. And Q1 has been a pretty strong quarter in general, so this low number for the guidance really makes the market feel uneasy about the future growth potential for Netflix. Now, Netflix says that the reason they guided so low is because they believe that the end of the quarter is going to have the majority of the content coming out around March. So that will be interesting to see in the next earnings where they're guiding for Q2 to see is growth really stalling or not. But in my opinion, I don't think we should look at any single quarter and judge the company going forward. The management does believe in the long term. They have the ability to get to 600 million members and grow even beyond that. Reed Hastings has brought up those numbers multiple times. He's talked about it. He still talks about how streaming still remains a fraction of overall view time, and he thinks it's still in the early innings. So instead of just judging an estimated guidance as a long term trend, let's actually take a look at the past long term trends going on with Netflix and decide if the picture paints something nice or if there is a problem. First, let's start with ARPU, average revenue per user. This will continue to rise, or in Netflix's terms, they actually say ARPM, ARPM for average revenue per member. And as you can see, this photo was a screenshot I took of my TV yesterday, Monday, where it was showing the old prices of Netflix and the new prices. Basically, it went up $1 for the basic plan. For the standard plan, it went up $1.50. And for the premium plan, it went up $2. Now, these might sound like just small increases, but a dollar or two goes a huge way percentage wise for revenue. If you think about it like this, $1 more per month on 200 million members, that's $200 million more per month. Or it's $2.4 billion more in revenue per year on a $1 increase. Now, these price increases are just happening in the US and Canada, but that said, overall, Netflix does usually increase the price across the globe. They have been experimenting with lowering the price in places like India to gain more subscribers to optimize revenue, whether that means they can get more subscribers at a lower price to make a higher revenue, or if they'll later maybe increase the revenue, even if they lose some subscribers, to make sure that the revenue at all times should be as optimal and high as they can get it. And that is what they are doing based on the content they have there and the value add they think they can give. Next, we need to look at the product, because if the product isn't great, then their future is going to be basically not so great either. If they have an amazing product, usually that leads to hopefully an amazing future. Now, Netflix dominates in TV shows, and it has recently set its eyes on movies, and they're not doing too bad there either. If we're looking at the trends from Google search in 2021, when it comes to TV shows, Netflix was dominating the top 10, with 6 of the top 10 TV shows coming from Netflix. When it comes to movies, it's something they more recently have set their eyes on. In 2021, they had 2 of the top 10 movies, and this is straight up on Netflix on a streaming platform. These movies were not theatrical release movies. They weren't big box office movies hitting the theaters. They were Netflix trying to make big box office movies straight to streaming. Now let's continue to look at these overall trends and see what we see in this company. Well, one, if we look at subscriber growth, if we're just going year to year, we can see there's been consistent growth from 2013 through 2021 in basically all parts of the world. But as a whole, you can see how nicely the year by year growth is. Even if they're going to guide to a low quarter, you have to take a bigger picture and look at the overall trend. Are they growing year over year? And this is while increasing prices. Their prices are up significantly from 2013 till now. Now, revenue and operating income growth year over year is phenomenal. If you look at their revenue, it's the blue line. It has been climbing close to $30 billion in 2021. Their gross profit climbing along with it because they have nice margins, and their operating income as well. When I look at this chart, I don't see a company that is worried about growth. I don't see a company that is hurting. I see a very well growing company with healthy operating income and a great future ahead. I'm not going to judge a single quarter's guidance and determine what the next years are going to look like. This is a closer just graph on just the net income to see how much it has grown, and that even from 2020 through 2021 in the past year, net income shot up. Now, I will make note that one of the reasons it went up so much was they did spend a lot less on content in that year. So by spending a lot less in content, they were able to realize a lot more profits. But that said, the overall trend still remains going up and to the right. Now, margins. Margins were about 21%, pretty close to it for operating margins. Margins have consistently went up. Now, we do need to talk about margins because the company has always guided to about a 3% increase in operating margins year over year, 300 basis points, and they have been pretty on point with that, with the exception of beating that in the last 2 years. And we're going to see that here on this chart, and then projecting it to come down in 2022 as an estimate to be 19 to 20% instead of the continued 3% growth at 22%. Now, they do say it's because they're going to be spending a lot more on content, but the thing is, they also say that going forward, it's going to go back on track with this line of 3% growth, and it will even itself out. Now, they have been pretty consistent. If you can see 2016 doing 4.3% operating margin to 7.2% to 10.2 to 12.9. And they've been pretty much on track with the dotted line estimate that they've always guided to. So I won't be surprised if maybe they get around 21% or so in 2022. And in 2023, the operating income margin gets to 25%, which would put it back on line with the 3% growth that they've always anticipated. And they did make mention, they didn't say it would happen in 2023, but they said they expect it to get back on track. Now, management has made it clear that predicting sub ads has got harder over time. Sometimes they're overestimating and sometimes they underestimate. Now, the company has put this chart out in their earnings report, as they always do. And as you can see, they always have their forecasts. And if it's a red diamond, you can see that basically they overestimated in the forecast and they didn't hit that number. And when it's a green diamond, they underestimated the forecast originally and they beat it. So as you can see, they have many times overestimated and many times underestimated sub ads. Now, regardless if they end up being correct and it's only 2.5 million subs, if we look at Q2 of 2021, they only had 1.5 million subs that quarter, but then guess what? Q3 had 4.4 million and Q4 had 8.3 million. So having a low number does not mean you're not going to reaccelerate and to get higher sub growth ads in future quarters. So I wouldn't use their guidance as a one-stop shop for determining if this is going to be a good or bad investment. The next thing we need to look at is fundamentals. Their market cap ended around $176 billion. This is down significantly from where it was. Their trailing PE was showing around 35 with a forward PE of about 30. I believe even these numbers have come down slightly from when I took this screenshot. The PEG ratio, which is basically measuring its valuation with taking into account the fact of growth, is 0.98. Having a price to earnings to growth ratio of under 1 is incredible. This is it's just showing that Netflix is starting to trade really cheap for the growth they have. And they have a price to sales of 6.32. Around 6 times sales, I believe, is a fair number. I was a little worried. I didn't want to own it when it was 10 times sales, but at 6 times sales, I believe that's a fair number for a recurring revenue business like Netflix with continued high growth ahead. So, overall, the valuation metrics, I believe, at today's price become pretty fair, especially when you start to think about where they can be. So, this stock with increased revenue, and net income that will come from more subs and increasing ARPU is looking extremely cheap to me. The market cap's 175 billion. If they get 500 million subs paying $20 a month in average revenue per member by 2030 even, that would be $120 billion a year in revenue. If they're spending $6 billion a year on operating expenses, including marketing today, let's assume that goes up to $10 billion a year. And then they spend another $35 billion on content spend. We're talking basically about $45 billion of expenses between operations and content spend. You subtract that from the 120 billion in revenue, and you're left with $75 billion of net income, assuming those assumptions come true. Now remember, it costs the same to make a movie, regardless if you're going to end up showing it to one person or 500 million people. The budget for the movie didn't change. So the bigger the scale, the more profit. This is all about scale. And if you throw a P of 20 on that 75 billion of net income, you're basically getting a market cap of $1.5 trillion, significantly higher than the current market cap. So the potential going forward is insane. So as crazy as it sounds, if these assumptions come true, which I believe they will, I believe $20 average revenue per member and 500 million members by 2030 is not too hard to get to. If that comes true, even if it takes 10 years, this could be a 10x investment at those levels, 175 billion to about 1.5 trillion. Now, the great part about this thesis is even if I'm way off, the upside is so high, 10x, that I have so much cushion that they could have less subscribers or they could have just as many subscribers but less average revenue per member. And even if I end up where it's just a 2x instead of a 10x, it's going to still be a great win. But the potential is so high with achievable numbers. And there's upside beyond that because the subs could be more than 500 million by 2030, or the average revenue per member could be higher than $20. This is $20 currently, just to get an idea, is the high end of what they're offering today in the US and Canada. So obviously, they're going to be charging less in other parts of the world like India, and you're going to have to average everything out. But people pay $65 plus, even $100 plus for linear TV today. And think that Facebook has 3 billion people using their product on a monthly basis. There's a real chance that a company like Netflix could get to 1 billion users in the long run. Now, this long trend for streaming, this streaming thesis, has been the reason I've been extremely bullish on Disney stock. Both Disney and Netflix have the ability to hit this target, and I believe they both will be huge winners. But in the past, Disney's always seemed the better bet because they traded for about the same market cap, and I think they had equal potential in streaming. So you just got the parks, the hotels, the cruises, everything else that Disney has for free if you chose to buy Disney stock over Netflix, assuming at the end of the day, both of their streaming businesses would be about equal. Now, with this recent drop, Netflix valuation has come down so much that it now provides an immense value to hold along with my Disney position, so I am buying the stock because they are much lower market cap than Disney now. They don't have everything else that Disney has, and I still love Disney stock and want to own those other things. I think the cruises are coming back. They're going to have extra cruises coming online with a new ship this year. They have the parks with the reopening play. I recently was at a park, it was packed, and they are increasing prices across the board, making it a trip to Disney World being more expensive than it's ever been. And people are willing to pay it. So I love Disney, and now I also, at these prices, love Netflix. So yes, I'm buying Netflix. I put screenshots of all these different orders across multiple accounts I have. As you can see on the very far right, all these were executed orders. All of these orders happened on January 24th, being Monday, yesterday, and it was in total about 4,500 shares that I bought. This was between $356 to $370 a share across the accounts I have. Now, I put this here because I don't just say something's a steal of a deal. I don't just say that I think it's cheap for the long term, and then I don't put my money where my mouth is. I always buy when I say that I really think something's cheap and a great stock to hold for the long run. So I'm posting the screenshot so you see that I am buying, and I'm buying on this dip a lot. This is over $1.7 million based on the closing price of 387.15. So thank you for watching. I'm curious, comment below, what do you think about Netflix? Are you buying this dip? Let me know in the comments. If you haven't liked this video and you made it to the end, smash the like button. And if you're currently not subscribed to the channel, definitely subscribe. Until next time.